podcasting from a remote location somewhere deep in the heart of New York City. This is Crypto Characters, and I'm your host, Jason Nagy. Our guest for today is Julian Jacobson, co-founder and president of Fundamental Interactions and Velocity Ledger. Julian, welcome to the podcast.
Thanks for having me.
Okay, so let's talk a little bit about what you're doing and how you got started on your crypto adventure. So I like to start from the beginning in the business world from the beginning. Yeah. So what were you doing before that drew you to cryptocurrency, that drew you to fintech and blockchain and all of that? Let's hear about that.
So I'm kind of a lifer in the fintech, electronic trading space, straight out of college. And I guess 8 years ago, we started a company, myself and two partners, called Fundamental Interactions. And, we have provided electronic trading systems, market-based systems for matching engines. We'd compete with the NASDAQ, a Cinnober. And so we've been in the space quite some time. And I guess around 2012, 2013, we got fascinated with Bitcoin when it was a pretty scandalous idea, right? So you'd go to these meetups and you meet people that were somewhere in between like a Trek convention and an AA meeting, and everybody was really fired up. And from our point of view, it was an interesting way to take our technology stack and kind of bring it into a new future where kind of web systems could lay right on top of a matching engine, and you could build a little client base right on top of a market. So we liked that, and we started a company called Atlas ATS, which was a Bitcoin and Bitcoin options exchange, which did really well for a period. I think we saw that the regulations and the cost of being regulated became pretty high relative to the market opportunity. We stayed in the space, continuing to sell matching engines to the crypto community, but also to the securities community. And I think increasingly those two communities are kind of having a race towards the middle, right? So our securities customers want to be more like crypto venues, or we at least want to be able to use digital assets. And the same is true for the other side of the spectrum, right? So we've been kind of in between these two markets, providing a lot of technology as a vendor in the U.S. for a long time, and have really kind of developed our technology stack around our observations and our experiences there.
So I want to stop you because you got a little further than I thought. Matching engines. You had a lot of good words in there, but let's make sure that anyone that listens to this can understand. Why don't you explain what a matching engine is?
Sure. So if you run a marketplace in traditional securities, let's say equities, options, futures, or even crypto, you basically have an electronic market center where orders are routed in, they match. There is market data feeds that distribute the pricing information out to the street. You have a lot of different standards that you have to follow, including regulatory reporting requirements, performance requirements, uptime, scalability, fault tolerance. All the things that you need to do in that area are very critical mission sort of enterprise functions. And so the matching engine really is the heart of an exchange. And we do that all over the world in a lot of different asset classes. And cryptocurrency has become a very important one of those asset classes for us.
So what does a matching engine do? Does it do best execution? Does it enable best execution? And let's also not use industry words.
Yeah.
So when I say it, you can kind of explain what that stuff is. But for someone who doesn't know what a matching engine does,
right.
What does it actually do?
Well, so the matching engine is just one part of our technology stack. But what it does essentially is it takes customer orders that are routed electronically in, and it matches them against one another. So a buyer and a seller pair off, you match it, you report it to the regulators, you distribute it over your market data feed, and you're essentially creating an orderly marketplace, electronic marketplace, where participants can come in and trade with one another.
And is part of what the matching engine does it make sure that the guy that wants to purchase at X price gets as close to X price by matching it with the seller that wants to sell at her best price? Is that what it does?
Well, yeah. Typically, there's an algorithm underlying the matching engine, price time, price size, which kind of says these are the rules by which we're going to pair these orders. And principally, you're looking at firms like a broker would kind of take all of their customers and provide them access into the market, and all of those orders kind of coalesce and match in accordance with that algorithm inside the matching engine. It's typically a price time book, right? That's what we're all used to, and you should get a very reliable outcome when you send an order into a central limit order book.
Had you been involved in markets before you went into cryptocurrency?
Yeah, absolutely. So prior to Fundamental Interactions, I had an interesting kind of trajectory, when around the year 2000, and I'm dating myself here, but, when I got out of college, I, by pure, happenstance, got a job with a company that was doing some really disruptive things called Townsend Analytics. They were basically, it was the time of the internet, proliferation, and so you had a lot of day trading, and you basically saw this big shift from floor-based trading on physical exchanges to kind of upstairs trading, as they'd call it. So people were migrating from the pits to screen-based trading, and so Townsend, that company, was providing trading software and also matching engine technology, which they created Archipelago, which was later acquired by the New York Stock Exchange. And so for me, that was formidable because it's important for a young person. You walk out into a space that's being disrupted, and it's a good opportunity for you to figure out, A, how does it work, and B, how's it going to work in the future. And so around the internet, there was a big sea change, and I got to be a part of that, which was great, and got really deep into market structure, really deep into kind of how these systems work.
So let us all know, how do they work? Market structure, right? So these are things that I grew up, I only saw myself being a lawyer growing up, right? It wasn't an option for me to even delve into markets. I didn't understand them. So are there any general rules that someone who doesn't, the uninitiated should know about, right. Just kind of how these things work?
Well, I guess my view on it is that, you're never going to understand things that are really complex without getting deeply involved, right? And I think that one thing about capital markets is that they're extremely complex, in different ways, different mm-hmm. spaces, right? So electronic trading is, an avenue where, it's a very mature field, right? So there's been a lot of, money invested, a lot of brain capital, brain power has been invested in that space for decades now, right? So, right. There's a lot to know, I guess, is the first thing to understand, and that there's a lot of different arenas that are relevant, right? The regulatory arena is very relevant. What private companies are doing, vendors, what the investment community is doing, whether that's hedge funds or banks or brokers or prime brokers. It's a very layered marketplace with a lot of behavior in it. So I guess one thing to realize is that, you should be humble even if you're extremely experienced, because whatever you know is just a fraction of what's going on.
That's actually good advice in general, I think, right?
I think so, yeah. A little bit of humility goes a long way.
It does, because when you make a mistake, it's not as obvious as well, right?
You can't make mistakes with other people's money.
No, no, you can't. Okay, so now you got involved essentially at the beginning of the day trading craze, right?
Yeah.
What was that like?
It was kind of, history doesn't, we were listening to Michael Turpin speak the other day, and he made a good comment. It was that history doesn't repeat itself, but it rhymes, right? And so what we're seeing right. with blockchain, what we saw then, these are, basically kind of similar parallel tracks, right? You've got this behavior that's kind of simmering up through kind of this new advent of technology. Mm-hmm. And that behavior kind of coalesces a lot of momentum, and a lot of people start to get involved. The day traders in that period of time were getting, making a lot of money and getting a lot of attention, right? But I remember that. But it was extremely below, it was way below the radar of what any of the bulge bracket firms would kind of look at or care about, right? It was years before they decided that some of that functionality was something that they wanted to be involved with owning, involved with institutionalizing. And
really?
Oh, absolutely. So if you looked at kind of the SOES bandits, if you look at kind of all the day trading that was happening, it was, at least in my experience, the technology was pretty developed by the time the banks got to the table. And when they got there, they made it, they built upon, they institutionalized what was there, right, and made it more palatable to a hedge fund or an asset manager. But basically, you had a lot of technical capability developing outside of the banking structure, right? And the crypto is the same way. You've got this massive proliferation of new protocols that are being used globally. It's not what's happening in the banks, right? The banks are waiting, watching, figuring out where they want to get involved, and it's not with kind of rogue new models that may crash and burn, right? It's not with big capital raising events that are kind of predicated on unknowable, results, right? They've got apple carts. Crypto is small relative to what other asset classes and what they're doing, and the risk of kind of getting involved is kind of greater than the short-term benefits, at least.
So how long did it take for the whether they're bulge bracket banks or institutional to get involved in the tech behind the day trading?
In my experience, I dropped into that whole situation in 2099, and it wasn't until probably 2003 that Realtek was starting to get a lot of institutional, let's say, penetration. So the first thing they're going to do is start kind of testing the platform and seeing if they can use it, and then you get into this next stage of M&A interest, and but it took a while. I think those cycles are condensing. I think that what we're seeing, crypto is going to play out a lot faster, and on a much more global scale. So we're
already is, right?
Yeah, and the amount of money at the table, is a lot of money. A lot of money, rushing into a space that quickly, right? And it's not just kind of cottage money. There's a lot of money coming from a lot of different sectors, right? Whether it's the corporate sector, M&A, whether it's private capital. There's just a lot of money on the move around these new protocols and these new decentralized common ledger behaviors. So I think things will play out much faster, and there's a lot of people making a move.
So I was listening to someone talk about the way disruption happens, and they were going back to the 1800s in the U.S. The way that the Sears and JCPenney, it might have actually been JCPenney, disrupted the manner of selling clothes, essentially. And they talked about A&P. I don't know if you remember the A&P supermarket.
Of course, yeah.
So essentially from the 50s up until the mid-70s, A&P was the supermarket.
Mm-hmm.
And it was based upon one theory that no one really understood or realized. And the theory was people are living in the cities. They started moving to the cities in the 20s, and they stayed really through the 50s. But post-World War II, everyone started to move out to the suburbs because you had automobiles, and that changed the way that you could do things. And so A&P's market was they had stores in concentrated population centers, and you would have 10 of them in New York City, for example.
Mm-hmm.
And that was how they made money. They made a lot of money that way. But once the automobile came and people were moving further out to the suburbs, they couldn't come all the way into the city and use A&P stores. So A&P's model was disrupted, but it was disrupted very slowly. And so it wasn't until the mid-70s where they lost $150 million in 1 year. Up until that point, they were very profitable. The next year they lost like $200 million, and they went down from there, and now no one even knows who they are.
Mm-hmm.
So, when you look at it from 1950 to 1975, that's a 25-year span.
Mm-hmm.
You're right about the compression, but I think it's also, as I listened to that, all I could think of was, Bitcoin, right? Another thing that someone was talking about was how Macy's and Sears and all these large companies, they refused to use bank credit cards.
Mm-hmm.
They didn't do it. They said, we're not going to use it. And that's literally Bitcoin and retailers, right? The big, we're not going to take Bitcoin. We're not going to take Ether. We're not going to take whatever the cryptocurrency is. And now everyone does, and no one even uses cash anymore.
Yeah, I think we're moving towards a cashless society. I don't know Bitcoin or Ether and the point of sale and how kind of quickly or whether that kind of takes off the way people think it might. To me, the big disruptions in the ledgering of information and being able to do that in a common way, as opposed to everybody having their own kind of ledger and having this kind of Tower of Babel component with all of your protocols and all your data.
Interoperability, that's what they like to call it, right?
That's
so
right, yeah.
Why don't you talk a little bit about not interoperability, because that's just a buzzword. I hate disintermediation. I hate interoperability.
Yeah, it's horrible stuff. Yeah.
They're just terrible words. Although I do use them occasionally, just for fun. But let's talk about the Tower of Babel.
Mm-hmm.
I mean, why don't you take us through all of those things?
Sure.
And with what is it? MasterCard does 24,000 transactions a second, right? And Bitcoin and Ether do like 10, respectively 10,
right.
And Ether's like 100 per second or something like that, right?
Right. So on one level, cryptocurrency is a transfer mechanism, right? So we can pay each other on a peer-to-peer basis. But I think on another level, it's just a database structure, right? Where we're saying, in electronic trading, the big advent was FIX. FIX was basically this common protocol where if we were both kind of adopting this standard for communicating about data, we could all do business with one another with very little friction, right? So,
right.
Any major financial organization that accepts electronic order flow is accepting FIX 4.2 or whatever the latest version is.
What is
right?
FIX 4.2?
It's basically a protocol, right? It's basically saying we're going to communicate about something, and when we do so, we're going to do so with a set of guidelines, right, and rules that are going to govern how we format our language, right?
Okay.
And so that was, that was a big deal for electronic trading because it meant that you could really proliferate a lot of technology. A lot of people could talk to one another. I read an article in The Economist that was talking about kind of the power of the common ledger, and what they were basically saying was that there was a time when, let's say you and I were both kind of cobblers in different villages, right, and we were both kind of trying to talk about what we did over the last year from a books and records standpoint. We wouldn't have the same definitions. What's revenue? What's debt? What's an expense? Right. How do we count for this, right? So if you and I tried to compare our books, there would be no common basis, right? We wouldn't be able to say, this is it, right?
Right, yeah.
And so GAAP accounting is another example of a protocol, right? So the concept is that there's some ground rules for how we're going to do this very common thing, right? And this
exactly.
common thing with with Bitcoin or with crypto is basically how we're going to database information. Right, and so these standards allow us, some common way, so that we can all get on one kind of fabric as opposed to this kind of patchwork. So Babel is really, I have a database, you have a database, she has a database, and you need a separate API to get into any of them.
What's an API?
Programmer's interface, right? So if I want to get at your database, right, it's something that you have internally, you manage the standards, you manage the protocols, and you're not doing that thinking about some global kind of interoperability, right, to use that word again. What you're thinking about is...
Excuse me, I have to puke.
You're thinking about what do I need to do, right? And so when we think about securities trading, by and large, all these firms have their own database structures, right? So when we do settlement, we do reconciliation, and we have a lot of effort goes into kind of verifying that, the records are correct here, 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 and here.
Right.
And we're basically translating across all of these uncommon formats, right? So in a world where there's this kind of lower level commonality there, it's the sky's the limit what you can build on that, and how you can kind of change service models, and how you can change how you interoperate with other people. Interoperability is big because what you're saying is that we don't have this same friction, right? We're speaking the same language now.
Right. There's no DOS versus iOS, right?
That's right. That's right. So we're basically saying once we're on the same standard, a lot of new kinds of architectures are possible, and a lot of you can basically disintermediate a lot of things. And in securities, when we think about securities laws, this kind of takes us right into the heart, of what's going on in the U.S. You've got, you have basically a bunch of regulations that presume that all of these actors are going to be kind of separate, right, as opposed to acting in one common ledger, right? And so there's
what do you mean?
So if I'm the SEC is not going to allow you at this point in time to kind of use a common distributed ledger to trade securities in a multi-dealer market. They're just not going to let you do it.
Right.
So if you do that, right.
Right.
What they're doing is what's a blockchain, right? It's pseudonymous, right? It's global. It's decentralized. It's it's basically one ledger, not many ledgers. Is the thought process there, right?
That's a very good point.
And so if you think about what a security is, right? It's that blockchain structure kind of presumes to be your transfer agent and your custodian and your broker, right? Whereas in regulated securities markets,
they're all separate.
Yeah, those are kind of regulated as separate entities, which
right.
are necessary to have in the trade, and they're kind of need to hand the baton in an approved way, right?
Mm-hmm.
So there's a lot of dissonance there. What do we do with the blockchain in the United States, right, at this stage?
I'm going to tell you something. I never really looked at it that way, but it's a great point that maybe part of the issues that everyone is having with the SEC and that the SEC is having with blockchain and whether a cryptocurrency is a security is that very different nature.
Mm-hmm.
Because, there is one thing, right? It is a program. And the SEC looks at who's behind the programming. If you look at listen to the Hinman statement on decentralization, they're looking at, and even the recent guidance that was given, the unofficial guidance that was given by the SEC, they're looking at the people that are behind it. It's not really the promoters, it's the people that are making the decisions to determine whether or not they're running it. And one person running all of the markets combined via a blockchain,
mm-hmm.
or one blockchain running it's a problem from a regulatory perspective. That's a great point. I never thought of that. You blew my mind, man. You blew my mind.
Hopefully the folks at home find it interesting as well. The lawyers were just dorking out here at Polsinelli.
That's right.
Well, yeah, I think there's an incompatibility between kind of what happens on an open blockchain and kind of what happens in a secondary kind of multi-dealer market, right? So if you want to be on an exchange, there's it can't happen here condition in the U.S. around, trading and using open blockchain. So our company, we've been building blockchain into our core application stack for years now. And so we've developed a private blockchain, right, inside our four walls, right, mm-hmm. where we can essentially, utilize that layer in our application stack so that you can do all the things that you do on a matching engine in a regulated market, but then you've got this private blockchain layer, right? And we think that that's going to be something that it will be approved sooner than later, right? Being able to trade in a private blockchain, right? Because it's more like a database, right? And it's less like, putting things on if you go talk to certain compliance departments out there, they say, I can't be involved with the public network because I don't know who's in there, right? It could be, so I don't know who the actors are, who's mining, who's doing what, right? It
could be a terrorist.
It's anonymous, and therefore it's out of bounds, right? And
mm-hmm.
so, in a private network, you can control for who the participants are and what are the swim lanes and what everybody needs to do. But I think a lot of the power of the blockchain is in the open network, and being able to kind of verify that everything is the same everywhere, and kind of use that as a kind of a custodial kind of beacon and say, the network can safely kind of hold the coins on behalf of, the rightful owner, and applications, enterprise applications can go ahead and trade and then commit back to that layer. So we have this private blockchain, mm-hmm. right, where, in one deployment that we're doing for customers, it's simply a wall-gardened private ecosystem where people, they're trading, the blockchain is essentially moving cash for securities on every trade, and then you have all the common controls that you'd have in a matching engine and an exchange stack. But then, in other deployments, we're really leveraging that public blockchain, where at the edge of our private chain, we have integration to a lot of different entry points. And those entry points are typically public protocols, whether that's Bitcoin or Ether or whatever kind of standard is, people are using to represent a digital asset and the ownership of that. Or it could be custodians or transfer agents or whatever, whatever the kind of, whatever the, is required, right? So there's a lot of different assumptions that go into what you're doing when you're using a blockchain to trade, right? Or to at least to hold the ledger.
That's true. You're right about that.
Yeah. So for us, we kind of live in multiple worlds, right? So we have 70 plus customers. A lot of them are, pure crypto. A lot of them are pure securities. A lot of them are some hybrid between those two things. Mm-hmm. And you have to really think about, if you're a builder of a commercial platform, right, that many customers use, you have a different consideration than what a single operator might have, right? You might just build your stack based on what you think you want to do, right? We have to build kind of technology that can be used by many, many, many firms in a service bureau capacity, right?
And that's what you're doing.
That's what Fundamental Interactions does in the U.S. and globally. There's a lot of exchanges running on the platform. And I think that a lot of them have different views and regulatory imperatives, when it comes down to, how are you using a blockchain, or are you using a blockchain, right? And how does this fit into your kind of, your objectives, right?
You mean from your customer's perspective?
Right, and what market you want to go after, right? And kind of what efficiencies you're trying to extract from the use of a blockchain in a securities trading context, right? There's different ways to go about it.
I see. Yeah, that's a very good point. So how do you guys do that?
Well, so securities exchanges that run our technology oftentimes will start off with a bunch of kind of assumptions, right? And those come from the jurisdiction that they're operating in and the stakeholders that are kind of on their exchange, and what kind of stuff they want to actually go after, right? So typically, if it's a kind of a mature securities exchange, they're looking to use blockchain to, we're creating a clearing and settlement kind of facility for one of our clients, which is a regulated exchange. And essentially what they're trying to do is kind of have real-time settlement, minimize the amount of time and the cost of capital in the settlement process.
Okay.
Right, kind of replicate what they do now, just make it be faster and make it kind of more efficient, right? And then also kind of have it be ready as the kind of regulations ease up to go to that next layer, right? So
what would the next layer be?
Well, so the next layer is
tell me what the first layer is.
The first layer is a private network, that's running on a blockchain, which is in many ways not that dissimilar from a database, right? But it's something that has, I think, some great design elements, right, relative to using databases. But the main difference there is that they're not using public networks.
Okay.
And public networks is kind of the blockchain, uses public networks, the decentralized global network. Every node has the same information, right? And so there's a lot of power in that. So, the other model that we're very intimately involved with in terms of Velocity Ledger, in terms of how we see the world, is basically real-time public network settlement with custodial wallets, right, on a public network. And that's a different kind of thing, right? So if I trade...
When you say custodial wallet, why don't you explain what that means?
Well, typically a custodian is an entity that holds securities on behalf of participants, right? And when we think about a custodian in think about BNY or State Street. These are firms that have like 30 trillion in assets under management, right? And what do? They hold your securities so that you can trade in different venues, and at the end of the trading session, all the information is reported to the regulators, and then it goes back to, if it's equities, it'll go back to a central clearing facility like DTCC, and then the custodians will look at what got traded, and they'll basically square off against one another, and they will settle, right? So cash for securities, and so that's a kind of a dealer-to-dealer model, right? My dealer has a custodian, and then the custodian operates on behalf of that dealer. But with blockchain, you've got a different kind of assumption, right? The assumption is that a public network is very good at safely custodying assets on behalf of participants, right? So you maybe would still want to have a custodian in that flow, but not because he needs to follow a bunch of Byzantine instructions in order to settle. The network's going to do that. What he's doing, essentially is acting as a company that will be regulated and be insured and be able to kind of have your wallet for you, right? And so if you trade on an exchange, settlement occurs after a period of trading, and there are a series of confirmations, and then coins are moved on the public network between custodial wallets, right? And so they're really just kind of fulfilling a model where they're a good backstop for you, right? They're going to be insured. They're going to be making sure that they only participate in certain kinds of markets. It's a different sort of game than what custodians are doing in regulated markets in the U.S. and other places.
All right, so when you say custodial wallets, you're talking about another entity. Let's just use a big bank, for example, and that big bank has a wallet that it puts everyone's. Is it like an omnibus account wallet you're talking about?
Well,
or do you mean on an individual level for the custody?
Well, so I think those are kind of details that would kind of fall out of the structure, right? But I think at a high level, think about the public network as just being, tokens moving across a network, and kind of, wallets will hold the tokens. Those wallets will be kind of in the possession of a custodian, right, as opposed to in your personal possession, right?
Right.
Or maybe if you're operating in a market where you want the end user to have possession, you can enable that as well. But I think we're moving towards the institutionalization of this technology, right? Where a custodian brings a lot of they bring confidence, investor confidence to the table, right? Because you want insurance and you want to know that your custodian is going to be there no matter what kind of problems might occur.
That they're not going to die with the knowledge of all the private keys,
right? Or if somehow they kind of if they lose access to the keys, you're still going to get your money back.
Actually, that's a real problem, isn't it?
Of course, yeah.
Huge. You need to have redundant keys, and if you do that, then it's not as secure.
Yeah. Well, you have to have a backup mechanism. There's got to be a way to kind of be safe, but also be smart.
Right.
It's not acceptable that an enterprise grade system will take that kind of a risk, right? And I think so. I think what we're seeing is when you see the SEC and other big players kind of waiting and watching.
Right.
Part of it is that I don't know that there's a really great level of confidence that everybody can kind of play those roles right now with the kind of security and acumen that would be required, right? So not everybody knows how to kind of architect a walleting solution that's secure and that's going to kind of work. And that, I think there's a lot of development that there's a lot of infrastructure that's lacking right now. So when we think about the SEC kind of standing in the way and these other things, that's not uniquely a bad thing, right? Because there's a lot of motivation on behalf of the private sector to go out there and get a model live when you haven't really figured everything out yet. And I think that, in mass, there's just a lot of infrastructure that doesn't yet exist in the industry. And so part of that is just kind of, knowing that the walleting is, and the kind of, custodial walleting, landscape is, pretty well served, and, we know how everybody's, best practices are being conducted, and we compare one to the next and kind of be able to come away with concrete conclusions. Right now, it's a bit of a turkey shoot in that regard.
And when let's also just step back about wallets, because if you go on the Bitcoin blockchain and you become a node and you get Bitcoin that's issued to you because you solve the algorithm, you figured out what the hash is, it goes into a public address, and that's yours. So that's your wallet, and it's public. Now, how does the public wallet that an individual owns because they have Bitcoin, how does that compare? How does it interact with the custodial wallets that you're talking about?
Yeah.
Because custodial wallets really are more, I think, that when people talk about that, they talk about that more from a securities perspective.
Well, think about it. In crypto, possession is 10/10 of the law.
Right.
Right. So he who holds the private keys, he or she who holds the private keys, is you're the custodian. Whether you're the owner or the custodian, or whether there's other terms that encumber that possession, right, is kind of the secondary order of truth. Right. The first is that if you've got it, you control it. And so giving control over to a custodian would benefit an institutional participant in a number of ways. First of all, if you're going to create an exchange that's going to trade securities and utilize blockchains, for the settlement component or the issuance component, then you're going to be able to convince investors that it's a good idea if you've got custodians that can come and play that function, and they can kind of hold those wallets, hold those private keys, and be involved in the operating procedures of the exchange, where those keys are kind of released and where settlement is kind of conducted.
Right. So, but the problem, I guess, is that if you have all of your cryptocurrency, whichever, Ether, Bitcoin, Litecoin, one of the main ones, right? And it's held at an institution, and it's lost somehow. It's not like it's stock where they can issue new stock, which is really the way it used to be, and that's what the older model runs on, which is I'm the custodian. Oh yeah, we can't find your stock. Here's your stock. We've removed the other shares that are in existence.
There's a different risk profile for a custodian in this space, and that's probably part of kind of the growing pains. Because when you go to get a custodial broker dealer approved, as there's standard written procedures, right? And a lot of these, the industry's been cutting and pasting for a period of time, right? Now it's time to kind of figure out what's happening here in our organization, as it relates to specific operations with specific venues that are allowing us to hold funds and settle, with customer funds. So it's a really different world, and it's an exciting world in that way, because there's a lot of clarity that is needed, a lot of infrastructure that's needed, and we're all going to kind of cross the river by feeling for the stone, so to speak.
Hopefully, it won't get too deep, right?
Yeah, totally.
All right, so you've spoken about fundamental interactions at length. I know that you have a Bermuda project as well. So let's hear about what's going on in Bermuda, and why you chose Bermuda, why you didn't choose the U.S., kind of the issues that you see in both, and where you see them going, and if you see those two worlds meeting anytime soon, and how.
That's a great question. So as a vendor of exchange technology, as a blockchain-focused vendor in the U.S. and globally, we're arm in arm with our customers in the regulatory environment, trying to describe what it is they're trying to do with blockchain to regulators, right? And we understand where the friction is and kind of where the opportunities are. And part of the big opportunity is that in the U.S. you just see it can't happen here on a public blockchain as it relates to securities and multi-dealer facilities, right? Maybe one dealer can issue securities over his own network to his own customer, right?
And he's got all their information, and he has the right to take it away, because you have to have that in order to properly regulate it.
Right, but fundamentally you can't create the equivalent of a stock exchange in the U.S. today, where you can issue, trade, and settle on blockchains, and that's what we created in Bermuda. The basis of the Bermuda venture. So Velocity Ledger is an issue, trade, settle venue,
and that's the name of the venture, right?
Velocity Ledger, right? So there's a holding company, and then there's local companies in Bermuda, and one is a venue that's pending DABA approval. So what happened down in Bermuda is that they have created a new framework for regulating digital assets. And the DABA is the Digital Asset Business Act,
Okay.
which is essentially a pragmatic framework for regulating the use of public blockchains, right, in the process of kind of issuing securities. And so my partners, specifically Sean, our CEO, was very instrumental in kind of analyzing that regulatory framework and constructing a filing under DABA, which is still pending approval, to be a venue where we can essentially allow we can facilitate the issuance and trading of new types of securitized assets, digital assets, right? So we can take a REIT and tokenize it and trade it on the exchange. So it starts with an issuance event, right, where you essentially you do with an institutionally focused security something somewhat similar to what happened with ICOs globally, right? You do a crowd sale, right? But you do it to very carefully vetted participants, under the written standard procedures of the venue, right?
Okay.
And essentially, you can make tradable digital assets out of a lot of different things that the institutions would really like to be able to trade more effectively than they do today, right? So that might be REITs, that might be fund tokens, that might be stable coins, that might be debt instruments. There's a really big opportunity to create the kinds of securities that you want to see in the world, right? And do it from a safe jurisdiction where there's a really kind of high bar for entrance. You have to spend a lot of money to get approved. They don't accept everybody. It's extremely kind of well-traversed territory as it relates to financial markets, right?
Right.
Banks down there, the big reinsurance and insurance business down there. And so,
Yes.
so they've got a solid regulatory apparatus, and they've made a common sense set of rules associated with digital assets. And so we went out down to Bermuda knowing kind of what we think you should do, with blockchains as it relates to electronic trading. What's the right thing to do? What's the kind of sensible architectural decisions to make, and how do you help issuers, investors, venues kind of have a better market, right? A more powerful market, and we see that being possible down in Bermuda. And so it's a ex-US kind of opportunity. You really tune it to compete against or counter define against the activities that you really can't do in the States.
Are you hoping that the need to compete in general, in order to be a capitalist society that's functional, is gonna take root based upon what people are seeing happen in Bermuda and in other countries as well, to kind of shift the way people think about digital assets here?
Yeah, I mean, I think that the early innings of digital assets will be offshore. There'll be kind of early stages kind of proliferation of this model, right? Where I think developed countries can see that that's actually a very safe, well-functioning, orderly market where investors are, extracting benefits, and investors are, everybody's kind of doing what markets are supposed to do, right? So it needs to serve as an example, and then you see it repatriate. I mean, my view is that, in the end, or not the end, but eventually, we'll see this exact model in the U.S. and other developed countries.
Well, today, if you're in the U.S. and you have an ATS, you could trade digital assets to the extent that there are securities that are digital securities.
You're
correct?
Well, I think it really comes down to what are you doing, right? Mm-hmm. Are you settling on the public network? The answer is probably no, right?
Right. So is that what you're doing in Bermuda?
Yeah. So basically, you're using the protocols the way that they were designed, right? So that at the end of a kind of settlement routine, a controlled settlement routine, the funds move to the public network, right? And so that, in and of itself, is not happening on ATSs.
No, that's absolutely not.
Yeah, and so, but that's really what this is about, right? I mean, it's about this decentralized global network, right, where you can, leverage the power of cryptography, and essentially kind of validation of, the movement of these resources between entities.
Does Bermuda have due diligence for all of the, well, that it wouldn't be really a node, it'd be the wallet holders, the people that are doing the trading, or is that anonymized or anonymous?
Well, so
pseudonymous.
Right. Well, so I guess the pillar of kind of trading in regulated markets is kind of AML KYC, right? So the basis of any market that's going to be institutional grade is that kind of who's involved, and that they are carefully kind of vetted on the way in, and that once some entity is inside the market, you've done your risk assessments, you've kind of followed a set of procedures to verify who they are, and you're not using anonymous peer-to-peer transfers. You're moreover kind of taking the kind of exchange that we're all kind of familiar with on some level, right? Mm-hmm. And you're basically saying, we're going to allow this exchange to operate with all the same kind of maturity that exchanges have operated with, but we're going to issue and settle in a way that leverages the powerful decentralized blockchain network. So if I issue something, I can kind of issue that and make sure that anybody who's issuing it or buying it is a vetted participant, right? We know that this is not a bad actor, right? And then from there, they can do business with one another, right? They can buy and sell from one another. They can essentially settle at the end of a trading period. And what you're doing is not really kind of the kind of thing I do if I send you a Bitcoin. Moreover, you're just saying, these are enterprise applications using public networks for kind of tracking scarce assets as they move between participants, right?
So you still have the wallet holders, the people that are doing the trading, they're still verified.
Yeah.
Make sure that they're not terrorists or scoundrels or thieves, right?
Right.
But everything, the assets that they own are public. So in other words, someone knows who the pseudonymous entity is, who's behind the pseudonym?
Well, I think inside the market center, there is a mapping between your private wallet. So if we think about that exchange we were talking about being, foreseeably permitted and, regulated in North American markets or whatever the case is, right? You've got kind of a wall-gardened private network, right? And this
currently in the U.S. now.
Well, we're looking in the U.S. if you trade on NASDAQ, right, or NYSE or whatever, it's basically a little private network. And inside that network, everybody's able to trade and exchange value back and forth from one another, right? And you know who those participants are. Right. So this is no different, right? This is exactly the same in that context, right? In the sense that we know who's in there, and then we're conducting an orderly kind of system to allow them to trade. And the difference is this: that when you settle, you use the public blockchain.
Okay, all right,
but you can also issue onto that public blockchain. And so there's...
What do you mean by issue onto the public blockchain?
Well, when we think about issuance, think about the process of kind of selling securities to the public. Right. In this instance, you're kind of bringing a bunch of participants into a controlled environment, allowing them to buy securities from an issuer, right?
Okay, so the issuer essentially has their own address to receive whatever the compensation is. Right. And when they receive that, they issue the digital asset to the purchasing address, essentially?
That's what happens. Basically, okay. The mechanics, we can get inside the mechanics, but basically what happens is an issuance is done. Participants, basically come and buy, and at the end of the, at the end of the trade, you've got a settlement routine. So what's happening there is it's just a new way of conducting the capital formation process, right? So right now, we've been seeing kind of the echoes of this coming through kind of crowdfunding in the U.S., right? We were getting deep into kind of Reg A plus, Reg D, creating a portal at FI for our customers to kind of act as a crowdfunding portal, right, on behalf of customers. So that a dealer will come in, issue securities under some exemption, 506B or 506C or Reg A plus or whatever it is,
they'll sell securities out, people will come and buy them, and then that's a more efficient way to do a deal, right? In theory, right? But it has been to date a failure to launch in the
Reg
US.
CF? Yeah.
All of the kind of crowdfunding models did not kind of achieve the kind of predicted level of penetration. Everyone thought that crowdfunding is going to be a game changer, right? Because now we can do these kind of one-size-fits-all deals where I'm not pushing cap tables all over the place. I've got a really kind of orderly way to sell a lot of securities to a lot of participants in one shot, right? As opposed to some kind of lawyer-facilitated deal.
IPO.
Right. I mean, so IPOs. The thing about IPOs in the U.S. is that they're fewer in number, and the exit ceiling, the size of an IPO has to be massive, right?
Right.
So capital formation is problematic when the VCs kind of dominate the early stage capital game, and they're looking for a set of conditions will allow them to IPO a company. And so if your company doesn't look like the type of company that's going to be worth $1 billion, that's going to be a unicorn, then it's not of interest, right? And so what we've seen is that the cost of having a publicly traded security, the cost of kind of that whole endeavor is too high. And so you just see a dearth of kind of capital at the levels where it's most critically needed, right? I mean, we know dozens of people in our lives that kind of are kind of bootstrapping a company, right? And they're out there trying to make the most of, freely available, cloud-based software to do anything they need to do to run their business. They're writing code. They're doing whatever they're doing. They don't need to be a unicorn to be valuable, right? So I think when we think about capital formation, we think about how we can more adequately serve the needs of people that need to raise capital, right? And does it need to be some massive event, or can it be something smaller, right? I think in Bermuda we're focusing on institutional types of securities. This is different from the crowdfunding value promise in the United States, but there are some similarities, right? Because you've got this model of doing this open sale, right, of securities or digital assets in this case, out to a lot of investors.
In Bermuda, you mean, or in the US?
In Bermuda, but if you looked at all the ICOs that happened over the last couple of years, that was the kind of design assumption, right?
Yes,
that they
it
were
certainly
just going to say,
was.
come on, everybody, come buy these securities from our website. And the problem with that is that you don't have the protections, right? People got fired up.
There's no disclosures.
There's no disclosure
about the fact that you may be buying a complete piece of dog doo-doo.
There's basically a lot of wacky stuff got sold to a lot of unsuspecting people, right? And the problem with that is there's just no recourse, right? So what happens is you lose all the investor confidence, right? Now ICO is kind of an ugly
Dirty word.
It's a dirty word, but I don't think, I think there'll be new words, right, used to describe some of the same behavior, right? Because what's going to happen is you're going to see kind of public sales, right, that are going, that are going to kind of follow that mechanical kind of process, right? But there's going to be more, securities grade regulations underlying and protections, and people are going to be able to be more comfortable about what happens if something goes wrong for me, right? If we determine that one of these guys was a bad actor, or we determine that there was fraud or whatever, there's recourse, right?
Right.
So the whole crowdfunding piece is kind of an interesting kind of journey, right? Because it was, if you see the amount of money that was spent on it in real estate and other areas to try to make it work, right, to fix problems that exist in those, securities issuances niches, they were all kind of manifest failures for the most part, right?
But when you say crowdfunding, you're talking about not just Reg CF, which is up to $1.1 million. You're talking about Reg A. You're talking about Reg D, Reg A plus, all of it.
I'm talking about
the Jobs Act, essentially.
Exactly. So, but a group of investors coming to one site and buying a bunch of securities, right? From, it's a different process, right? So that whole act, under whatever exemption or regulatory umbrella it happens, there's kind of a behavior there.
right? And that behavior makes sense, right? Doing these kind of one-off deals where kind of all the paper is really heterogeneous and where, you know, you're going to need to engage the lawyer every single time something happens. You know, there's a very heavy structure that exists as the incumbent and the alternative, right? But if you go down that path, right, and the crowdfunding and blockchain are just bread and butter, right? And they're perfectly suited to one another because the blockchain is saying, hey, I can be your cap table. I can make an orderly cap table for you that's immutable, right? And
Automatically.
Right.
And it's just what I do.
Programmatic, right? So we can kind of enforce the rules kind of in a much more orderly way, right? And so I think that's kind of the ICOs kind of beat down a path for the popularization of that kind of method where kind of securities, you know, the securities issuance industry kind of had a hard go of it. It never became a really predominant method of selling Reg D paper, for instance, right?
Right. So, all right, let's talk a little bit about the word disruption, because we did speak about it initially.
In maligning terms, right?
Exactly, right. But there are parallels. So what parallels do you see since you grew up in the was it really the internet boom? Yeah, it was a dot-com boom, the bubble and bust, right? You grew up and you came of age in that as a business person, and you're, you know, blowing and going right now in the blockchain disruption. So what parallels do you see, having lived through both cycles?
Well, so there's so much in
one cycle. The other one isn't finished yet.
Well, they have so much in common, you know, because, you know, the internet and blockchain, these are low-level protocols, right? A lot of things get built upon a protocol, right? So it's something that's really below everything else, right? And that means that it's going to be really a challenge to what's happening to the incumbent model, right? And so, you know, there's a lot of problem solving to backfill that. You got to be a particular kind of individual to want to be engaged in that. So at FI, we've been, you know, fascinated by blockchain from really early days, right? And then we have big bulge bracket customers and big exchanges, and they'd call us in and ask us 30 questions out of curiosity, but looking at us like we were pretty much crazy, right? Like, why are you dealing with this kind of, this drug money payment mechanism? You know, what does this have to do with what you guys do, right? And you know, to me, it's just interesting, right, to be building something new and building it kind of with a strong foundation of how you think the current structure works, what its deficiencies are, kind of what behaviors might be better served in the presence of this new protocol, right? So you have to be kind of, you know, a little bit sure of of yourself, right? Because a lot of smart people are going to disagree with you. What you think is going on, right? And that's going to happen at every facet of your life, right? Your family's going to be like, "What are you doing?" Right? Your colleagues are going to say, "What are you doing?" Right? And at the
end, colleagues particularly, I think, said, "What are you doing?" Mostly.
Yeah. And people get really fired up in the anti-crypto kind of context, right? And I think when you see massive kind of bubble bursting kind of events, right? You have. Let's say it's more of a, they've got the high ground, right? So you're making an argument that things can be done differently, and that if they are done differently, that we can have these benefits, right? But we all got to kind of, we all got to work on it, right? We got to kind of move it forward. So in the internet age, it was about kind of saying, you know, right now there's just a bunch of dorks out on the internet that I don't want to interact with, right? But soon we're all going to be out there.
Right.
And we're going to be, you know, kind of exchanging information. I mean, if you told me in the year 2000 that, you know, my grandma was going to be on Facebook, I wouldn't, you know, she's not going to do that, right? That's not going to that's ridiculous, right?
Right.
But so I think what's happening is that, you know, if you're curious about kind of how the future is going to work as it relates to your field, like, you know, then it's a feast for you to think about it from that perspective. So that's what makes it interesting to me. You know, it's just, you know, where is this going, and kind of where will this lead us? There's a
it's much different from working in a bank, right?
Oh yeah.
I mean, where you're siloed and your future is, people want to move forward with the belief that they understand exactly where they're going, right? And
Man, we really don't.
right, especially not if you're building blockchain technology, right? Because it's a rocky road out there for your customers and for everybody, right? So it's, there's been a boom and bust cycle. There's been just a lot, it's been a rocky ride, but, I think you just focus on the technology rather than the asset prices.
Right.
Then, you get to the right result.
Agree completely. I think that's 100% right. So you also mentioned that you see where there's friction between some of your clients and the regulators. Don't want to get into specifics, but where are you seeing the friction? Is it in stuff we've already talked about, or are there some additional nuances to it that you can enlighten us with?
Right. I mean, I think the landscape is pretty complex, right? But that overall, the friction is kind of how you can use a blockchain in an institutional capacity to kind of run your market, whether you can use a blockchain on the public network or not. And I think the answer right now is you can't do it in the U.S. in a multi-dealer facility. You can't do it with, we're familiar with a structure where an exchange is basically a place where a lot of brokers converge and they trade with one another on behalf of their customers, and there's a whole supply chain for that, right? And that supply chain in and of itself is regulated, right? Mm-hmm. So there's definitions for how you are to play those intermediating functions, right? As a broker, as a custodian, as a venue, right? And it's regulated down to the identity of the participant, right?
Absolutely.
And so all of that, there's going to need to be revisions to that in order to kind of allow people to use public blockchains, in a regulated market. You're going to have to see legislation. It's not going to be simply a function of saying, is this or is this not a security? That's kind of a base kind of level of kind of identifying, whether something, how to classify something, right?
Right.
As opposed to saying, hey, if we want to use these technologies, we're going to need to condone explicitly, certain behaviors, right?
So essentially, the friction is, can you even do this? It's like the basis level of friction.
And so what's happening out there is you've got a lot of groups in a state of wait and see with the regulators, and they're doing so with a tremendous amount of capital, right? And a big cost of capital.
Yeah.
And, that's tricky. It's hard putting a marketplace together. It's hard getting a market going in the presence of regulatory certainty, let alone in this environment, right? And so I think a lot of people kind of realize that, they could get capital, right, around these narratives, around blockchain, around securities. They know securities tokens is going to be a massive market, and if you just play there, you can get funded. I think there's just been a lot of there's been a lot of speculation on all sides, right? But I think there's a lot of models born of that same speculation, and a lot of them are kind of parked in traffic right now, regulatory traffic, and it's not clear when they're going to be able to do what it is that they want to do, and who's going to really benefit, right? So.
What do you mean by who's going to benefit?
Well, so if you're going to trade if you're going to trade on a private network, what is that going to allow your customers to do that they can't do today? Right?
Gotcha.
So I think, to me, we have a really mature financial system, right? And we have an extremely effective system apparatus for kind of capital moving around the institutional
Indeed we
community,
do.
right?
Yeah.
So the question becomes, where are the problems, right? There's a lot of problems. So there's a lot of securities that are trapped in paper form. They're basically, if you think about non-traded REITs, or if you think about, a lot of instruments are basically issued, they're purchased, and then they basically sit in paper form in an IRA account, and there's no secondary market. And if you want to sell out of it because you get some kind of a life circumstance where you need to you need to sell the thing, then you're going to go back to the issuer, and it's going to be a bloodbath for you, right? So
Right. Because they're not going to pay. There is no market, so they're going to pay you nothing.
They're going to pay a massive discount to value. And so
How many REITs or things like that are there that you can't liquidate?
there's a lot of paper like that.
Really?
And so REITs, it was estimated that there's something like 90 billion in stranded paper just for non-traded REITs.
Why is it stranded? Just because no one wants to buy it? Because there's no place to sell it, or
Well,
something?
the main reason it's stranded is kind of inside baseball. Basically, DTCC is...
Why don't you just say what that is?
All right, so DTCC is a central clearing apparatus that is basically like a trust. And the trust sits there and it says, I have full legal representation of who owns what in a given security. So they hold the registry for the security, right? And so at the end of...
For all of them?
Well, for any given security, you know,
That's publicly traded.
that is DTCC eligible, right? And if it's publicly traded, it's going to be DTCC eligible if it's an equity, right?
Right.
There's other structures in different markets and different asset classes, but let's just use DTCC as the example. If a security is not DTCC eligible, which many are not, non-traded REITs are a good example of that. You know, private paper, like if I start a company and then sell you some shares, right?
Right.
It's not going to be DTCC eligible, right? That's just that's just paper, right? So, and the paper typically will sit with the transfer agent, which is kind of and it sits in customer name, and it's basically, you know, it's not something that you can easily go and sell because there's no secondary market where people are listing it and trading it, right? And so it's stranded because the settlement rails do not serve that particular security, and there's a lot of that.
And do you think that using blockchain will open those markets up?
Yeah, and so immediately you
Because
see
there's literally not a place to physically go to say, I'm selling this, do you want it?
right.
You
so,
just need a place to do that. That's
yeah,
what you think?
I think that
Or the idea is not what you think, but that's the idea.
I think that there's a lot of groups right now that are moving forward with a model to say, I want to use this ledger to issue securities and to sell them to investors and to track the cap table and to track the dividends and to track, you know, just the basic information about this in a way that I don't have to keep it with a transfer agent, right? Like Computer Shares or SS&C or any of the other guys, right? And that in and of itself is a big advancement, right? Because you've got, anybody that's inside that network can kind of trade with one another. It's not what we do in registered securities, right? Where you have liquid markets that aren't trading in smart contracts, they're trading in limit order books, right?
Right.
They're fast, you got market makers in there. It's a different reality, right? So we're building a hybrid where you can issue into that kind of an environment, but you also have kind of a traditional matching stack where you can support that. So I think that what's happening is that
That sounds really cool, by the way.
Thank you. Yeah, I mean, I think that's in our view, that's kind of what's lacking, right? So it's one thing to build a website on top of Ethereum and then kind of use smart contracts to kind of govern who gets to trade with who and make sure that they're accredited and make sure that they're verified and those things. That's one layer, right? But if you want to really kind of, if you really want to move the goalpost, right, you want to provide secondary liquidity there, and you want to provide an environment where there's support for the security after its original issuance, and where you can get at lower market cap values some of the benefits that are experienced kind of in the public markets.
Fascinating. So, all right, I think you were talking a little bit about Velocity Ledger, but tell us what's next. You had some good press come out recently. Let's hear about it. Let's hear what you see the next steps to be, what your timeline is, and then we'll go to our final questions.
Okay, great. So we recently received approval from the Ministry of Finance in Bermuda to conduct an ICO. And so an ICO in this instance will be tokens that will essentially be used as a payment currency inside our network for Velocity Ledger. Velocity Ledger will be a global network for doing the kinds of things we've been talking about today. It's principally an issue, trade, settle marketplace.
Okay.
Right, where the the token will essentially be, we'll have a variety of different benefits. We're trying to build a network and build a community around it. But principally what you'll do is you'll come and use it as payment of services that you're using on the network, right?
Okay,
And
what services?
So issuing, trading, settling. So let's say, there's an issuance. You want to issue a new REIT, right?
Mm-hmm.
You can pay the network for that issuance in VL tokens.
Gotcha, okay.
Right, and then to settle, there'll be kind of VL used, kind of like gas in the Ethereum network.
Right.
So we're selling VL with the full blessing of the Bermudan Monetary Authority and the Minister of Finance, and there's a great.
No one from the U.S. can buy.
That's right.
No
that's
one
right.
from the
Yeah.
U.S.
So you're so fundamentally, the U.S. investors are protected from these types of investment. The SEC does not kind of condone what's happening, right?
Initial coin offerings are a no-go right now in the U.S.
Right. So basically,
Unless you call it a digital security, in which case it's a security and you're not issuing what would be a cryptocurrency that's to be used as cash on a platform in exchange for fiat currency.
Right. So for us, it's ex-US, right? And so we, it's going to be institutional. We're pending approval, as I mentioned, for our DABA license. And when the DABA license is approved, we think that we're moving steadfastly in that direction. Then, we'll open up the market in the summer, whether it's July timeframe, and then we'll begin serving customers there. And we're really excited about it because I think that, we spent a lot of time, perfecting the technology that we deploy here in the U.S. And what's going down in Bermuda, we think will be the best representation of kind of what's possible.
That's really interesting and exciting. That's great. Congratulations
Thank
for
you.
that.
Appreciate it.
All right, so for our roundup questions,
Right.
you've been in the business for a long time. You've seen a boom and bust. You've seen two boom and busts, actually.
Probably more.
Yeah, exactly. But the big one was the .com bubble, and then the ICO boom.
Don't forget the mortgage crisis. How was it Lehman?
That was a thing.
How was it Lehman when that happened?
You were Lehman. How did you not even start with that?
Yeah.
What was that? Oh, okay, so what was that like? 2008. Lehman is blowing, going. Everything is fine for most people in the world, and it's just kind of moving forward. And then everyone walks in one day, and Lehman is pretty much shutting down. I was around the corner from Lehman's offices. That's where I was working at the time. So, all right, you were in there. What were you doing?
So Lehman acquired a company called Realtic, or Townsend Analytics was the company that made the product that everyone knows as Realtic. And so Lehman put Realtic on all the desktops of their biggest customers, right? So no matter what happened with Lehman, you were still penetrated, and all of the biggest hedge funds were kind of not just using our platform to trade with Lehman, but they were using our platform to trade with every other big broker out there. So we knew that whatever happened, the asset would continue on, and there would be some kind of, I guess we didn't know that. Those were crazy times, right?
Right.
So it's kind of like, is this whole system going to, break now, or So it was a little bit unnerving, but at the same time, kind of knew that as a vendor, if you're in a lot of different institutions, there's really no way to kind of unplug that, in its entirety. You're going to continue to kind of be in those institutions as long as those institutions continue to do what they're doing, right? So,
did you work at headquarters in 7th Avenue?
No, so we were actually really close to here on 3rd, 48th.
Okay. was it a giant Lehman building, or was
No,
it just
actually they had us off in a different space, right? I think that Lehman, kind of kept us at an arm's distance, right? We were all Lehman employees, right? But ultimately we were the vendor that Lehman had purchased, right? And in a lot of ways we were competitive because when they put us on, a big hedge fund buy side, we were enabling that buy side not to just trade with them, but to trade with all of their competitors. And so it was a really kind of interesting situation, and one where Lehman wanted us a little bit,
So you were saved from the bloodletting and the chaos on that day, at least, right?
Yeah. So that we saw some carnage, but it missed us for the most part. And then that was those times were crazier than the crypto times.
That's what. You're absolutely right about that. You get so, people talk so much about Bitcoin going up and down, and it hit 20,000 and all of these other. But you're right. That was a giant. I mean, that was the Great Recession. To me, we only started to have a recovery recently, I think.
Yeah.
Where people are not that worried about their jobs.
Yeah. I mean, it seems like there's this kind of 10-year period of kind of sideways. I don't know. I think that there's kind of it takes time to recover from that kind of systemic crisis, right? But that we definitely have a really motivated Fed, right? It's committed to doing whatever it needs to do to keep kind of the rates low and kind of keep the dollars where they want it. So I mean, I'm a believer in cryptocurrency, not just as a form of payment, but as a way to kind of take next steps as a financial community globally, right? Which means that you can see problems with the structure now, and you can figure out ways to start addressing those problems, right?
Yeah, very much so. So you've been through several boom and bust cycles. Good point. So what was your best lesson?
In the crypto world?
In all of your experiences, if you were to give advice to someone, doesn't have to be crypto, in light of all the things that you've seen, what would be the most important lesson that you learned?
One thing I learned is that when there's a crisis, you figure out how things work because you see things break and you understand when something's humming and everything's working fine, then you don't really ever see kind of the inner workings of the thing, right?
Right.
And that to me is interesting, right? When something breaks, you can figure out, what it is. And that's how it was in the mortgage crisis. If you want to understand, or the credit crunch, right? You want to think about how the fixed income market works. That's the best environment to understand that, right? If you want to think about kind of what's happening in crypto, watch it implode, right? and I think you see a lot there, right? Because I think, what the most recent history that we lived through in crypto was a world where you couldn't differentiate the BS from the facts, right? And then, and I think you had to see, this kind of this violent kind of correction in order to figure out kind of where the real value was, right? And now you see just a tremendous amount of ridiculous behavior kind of fading away, and there's a lot more kind of legitimate institutional approaches that are now becoming more manifest, right? So you can see the thread, right, of how this is going to start to work as people get it together. It's not going to be anything goes, right? There's going to be behaviors that build upon, they solve problems, right? And they build investor confidence, and they kind of make for a better mousetrap as opposed to just something that raises money fast, right?
Sounds like it's chaos breeds knowledge.
I think so.
Condense that, right?
Yeah, no doubt.
I like that. Can I use that? Can I use that one?
Please do. That's yours, man.
Okay, so anything interesting, new, fun coming up that you want to talk about, let everybody know about? Let's have your Twitter handle, your LinkedIn, your webpage, all that stuff. Let's get it out there. And we'll put it in the notes, too.
Okay, great. Yeah, check out Velocity Ledger. We're really excited about what's happening there. We think that's going to be just a really valuable kind of way of unlocking all the potential of the technology we built. And we think that some really great, businesses are coming down there with us to be a part of that model. And, if you don't know about it, you should take a look, read up on it, and get in touch.
What's the website?
VelocityLedger.bm and VelocityLedger.com, depending on which entity. But
okay.
Yeah.
All right, great. Well, thanks for coming on the show. Appreciate your
I
time.
appreciate it. Thanks so
Julian
much.
Jacobson.
Thank you.
Well, it's been 5 long years of this permanent midnight. I've been waiting for the sun to rise. I've been standing all alone by myself in this darkness. Man, I'm gonna lose my mind. And after 5 long years without any sunlight, I figured out how to play this game. Forget about the moon, the stars, and the sunlight. You're gonna get to know my